Good evening, everyone. A very good evening to everyone, all the students attending this online class. We can see Bhumika is there, Diksha is there, Subhashri is there, Ustad is there, Noor is there. A very good evening, everyone. Today we'll be starting with a really interesting subject of your CA intercourse, which is the financial management. So this subject uh, is going to connect you to a whole new world of financial education as well as financial analysis and decision making, uh, basically the financial decision making. Whether you want to take up a new project, whether you want to start a new company, whether you want to analyze an existing company, whether you want to decide, should I invest in this company or not? So this subject is going to be a guiding torch for you in the upcoming future. And this is also a base for your career in finance, which you can aim to be like a CFO. You can be looking for some lucrative position in investment banking, some positions into the stock markets, into the bond markets, into the money markets. So all those finance career options will be having the base from this typical subject. So this subject is going to be a base for all the future finance careers of you, right? So I can see a lot of people are already joining it. Mr. Vignesh, Ms. Reshu, Neeraj, Goma, Tushar, Dikshita, Jia, Ayush, Suraj, Manisha, Suruchi. Okay, and see all your messages. Let's just get this interactive session started right now with this subject, uh, which is financial management. In today's session, we'll get ourselves introduced to the topics that we have in this subject of financial management, and also understand what is the scope, what is the objective, why this subject is there, and then we'll look into one important parameter of raising of funds through various sources. I mean, we'll look into the various sources from where funds are possibly funds can be withdrawn or funds can be drawn for the business sources, right? So that's the agenda for our today's session. In the first half, we'll talk about the scope and objectives of financial management, as to what does a finance manager is supposed to be doing, and then later on in the second part, we'll discuss about the various sources of funds. Okay, so in between we may have a break of around 5-10 minutes. Okay, so let's get started with the subject, guys. Come on. So first, talking about the scope and objectives of financial management. Now this word financial management, I can actually divide it into two broad areas. Okay, so two important words that come from this subject, financial management. So the first word that we have is financial, and the second word that we have is the management. Now let me ask you some question. Tell me, what do you mean by financial? What comes to your mind when you see or listen this word of financial? Tell me, guys. What do you think? What is this financial all about? What does this word financial remind you of? Yeah, tell me. Yeah, money. Okay, capital of a company related to money. Okay, related to money, capital related to finance or money, getting money required for business, funds, Okay, so I can see that as soon as you listen this word of financial, the only thing that comes to your mind is the money, right? So this, according to you, this particular subject might be discussing all about what is money, right? Okay, so what you have is like it may be related to some funds, it may be related to some money or management of funds, right? I am pretty sure that your mind would have already started working to think about, this subject is all about something managing of funds. Okay, so right now, of course, as you said, we have financial definitely means something related to money, right? Financial means something related to money. But when we talk of management, that is essentially two parts. One is raising of resources and other is the utilization of resources. Now, when you look at raising of resources, obviously, since we're talking of financial management, we'll be talking of raising of financial resources. It means we are talking of from where are we going to raise the funds, raise the money. Second, where are we going to utilize the funds or utilize the money? Where are we going to utilize the funds or utilize the money? Now, raising of funds, we have it as owned funds and borrowed funds, right? Because if you want money, you can get the money into your business either from these two sources. Only these two are the sources possible from which you can raise the money. One is from your own funds, own fund sources, or from your borrowed fund sources, right? Apart from these two, can you think of any other source of funds? Of course not. Either it will be funds which are provided by your own people, that is you yourself, your family members, your equity shareholders, right? Or you can get the money from the banks, from debentures, right? So those are borrowed funds. So these two are the sources from which you can raise the funds. Utilizing the resources, it means there are utilization of funds, which comprises of three things. Utilization of funds. First is non-current assets. Second is the current assets, and third is the investments. So non-current assets are basically where you will put your money into the long-term assets basically, or the fixed assets which we have been using since ages. And current assets are those assets which are rotating in nature, right? So those are into the basically these two types of assets are for the operations. These two type of assets are for your operations, and investment can be made into some other sources which are not like as a not for the operations, not for running of business, not for generating revenue, but they are like the surplus funds which are parked with the intention to earn some income or profits from it, right? So these are the broadly three areas on which you can utilize the funds. So you can raise the funds, you can utilize the funds, and that entire activity of raising the money and utilizing the money are together called as the financial management. Okay, fine. Now, I can see some queries. Vignesh is asking, will government grants come under own funds and government subsidy will fall into is also a doubt from Himanshu. Government grants, government subsidy, they are ultimately a gift to the owners, right? So if government gives some grants, it's like a gift, it's a free money for the owners. So it's like an income for the business itself. It's not something you can say a source of funds, but it's something which has been received as a income, right? So yes, you can say it's own funds because with the government subsidy, the owners get a higher value addition. So that will be sort of, you can say, own funds itself. Okay. Now we have some of the chapters in this financial management which talks about each of these raising of funds or utilizing of funds. So first of all, if you want to raise funds, how will you decide from where you're going to raise the money? How will you decide whether you will take a loan from bank A or bank B? How will you decide whether you are going to issue debentures or borrow from State Bank or borrow from ICICI Bank? What is the deciding parameter? Yeah, guys. What's the deciding parameter about this funds? Where you are going to get the funds? How will you decide that? Okay, I'll take the borrowings from SBI. I'll take the borrowings from ICICI. So how are you going to decide that? Of course, you will calculate the rate of interest, right? Wherever the rate of interest is lower, you will prefer to raise money from there, right? So how to compute that rate of interest? That's what you're going to learn in the chapter of cost of capital. Okay, so cost of capital as a chapter is going to help you. It's going to tell you what is the cost of funds from various sources. Okay, capital structure is again deciding how much you should borrow and how much you should have your own funds. So capital structure is basically how much you should borrow and how much you should uh, take, how much you should invest as your own funds. So that's your capital structure. This chapter is going to help you with the balancing the debt and equity numbers, right? Third is the topic of leverages, which talks about the measurement of risk that a company undertakes. Because when a company is doing business, it's not without risk, right? Company is doing business, it's not without risk. So when there is a risk in the company, that needs to be measured and if possible, even managed. So how to measure the risk which the company is undertaking, financial risk, the operating risk, that will be covered in this topic of leverages. Okay. Then we have the next as a working capital management. This is the next topic which talks about utilization of funds and investment decisions, dividend decisions. All three of them are talking about utilization of resources. So investing, working capital and dividend, they tell about how much money should you invest in a typical project or in a non-current assets, how much money you should be investing in a working capital management, how much money you should invest in stocks, how much money you should keep pending with the debtors. So all these things are basically working capital management area. Then deciding whether you should really pay out dividend to your shareholders or not, right? That will be in the dividend decisions. So we can say over here that these three are talking of funds, and these four are said to be utilizing of funds. Okay, so investing, working capital management, dividend decisions, and ratio analysis. These are like not actually ratio analysis is not a part of it. Ratio analysis is altogether a different area wherein we are undertaking the financial analysis. Okay, so we are talking of ratio analysis in which we'll be discussing about the financial analysis. How are we going to analyze the financial health of a company? Okay, so that's a very broad area of topics that we have in this typical subject. Okay, let me see if there are any specific queries. Retained earnings will be under own funds, Darshan. Retained earnings will be obviously own funds because that's the money which belong to the owners which you haven't paid out. Okay. There is reserving funds for some uncertainties also included in utilization of resources. Reserving funds means you are investing in some area, right? So when you're investing in some typical area, that's sort of an investing activity. So that will be into the third thing, which is right. So that's also a utilization of resources itself. Okay, fine. Now let's talk of a very simple scenario. Which is, I'm talking of how do you know that a typical company is valuable or not? How do you know that a typical company is valuable or not? Or what are the factors on which the value of your company depends? Can I say value of a company is actually dependent on these three things? Okay, so your value of company, it depends on where the money has been invested, from where the money has been raised, and how much dividends are being paid out, right? So value of a company is a function of where the money has been invested, from where it is being raised, and you know uh, how much the dividend company is being paid. Now, if you want to increase the value of your company, simply investing over here, you should invest into, of course, more profitable projects. If you identify more and more profitable projects and put your money into those profitable projects, then of course in future company is going to generate profits, and that will ultimately add to the value of the company. Similarly, you should be raising funds from those sources which are the least costly. And thirdly, dividends are basically those decisions which affect the value of your shareholders, right? Affect the values of the shareholders. So these three are the activities on which value of our company depends. So you need to look for the projects which give you greater degree of profits. You need to raise money from the lowest cost possible scenario or resources, and also then you need to pay out dividend as and when required. So just keep this in mind that if you want to create value of the company, you should be following these three decisions very diligently. Okay. Now let's talk about what all things do we have in the scope of financial management. What is this? What is the scope of a finance manager to be specifically? Now, finance manager is supposed to be determining the size and rate of growth of the enterprise. Okay, so the finance manager needs to decide at what size, at what percentage is the company going to grow? What is the rate of growth that the company is going to observe? Whether it's about revenue growth, whether it's about growth in assets, whether it's about growth in subscribers, right? It depends on company to company. If it's a edtech, if it is a edutech company, if it is a some sort of video streaming activity company like YouTube or Amazon Prime or Netflix, so there the size and rate of growth parameters are going to be different. There they have the number of subscribers is a parameter for growth. Similarly, for a telecom company, the size of growth will be on the number of telephone users, the number of their line users, right? So that target has to be set by the finance manager based on the management guideline as to what should be the size of the company going ahead in future. Now, to obtain that size or to reach up to that size, we need to determine the composition of assets. We need to determine the composition of assets, which is about what all things do we have in that assets, whether it is fixed assets, how much current assets should we have, how much working capital we should have. So that decision needs to be made by the finance manager. Then determine what should be your funding sources, that is, determine what should be the debt equity mix. Debenture and equity mix should be determined. analyze, plan, control the financial affairs of the company. This is the operational activity of the finance manager. This is a day-to-day activity. Okay, so that's the role which a finance manager is supposed to be performing. Now coming to the objectives, what all are the objectives of the finance manager? Now here we are going to discuss in detail about two things. One is called as the profit maximization, and other is called as the wealth maximization. So talking of two things, profit maximization and wealth maximization. So tell me guys, do you think that profit maximization and wealth maximization or value maximization are one and the same? What's your opinion? Do you feel that profit maximization and wealth maximization are just one and the same, or are they different? What's your opinion? Tell me guys, what's your opinion? If I'm maximizing my profit, does that essentially mean that I'm also maximizing my wealth? Yeah. If I'm maximizing my profit, does that mean I'm also maximizing my wealth? What's your opinion, guys? No? Both are different. They're not same. They're different. Okay. Wealth is broader than profit. Okay, Darshan. Wealth is stock of assets or asset minus liability. Profit maximization is basically income minus expense. Okay. Okay. So just to tell you, profit maximization is a very narrow-minded approach, and wealth maximization is actually a broad-minded approach, right? So when you talk of profit maximization, it's a very narrow-minded approach. It's like just create profits for this year and you are done. It's a very short-term goal, right? Profit maximization. I want to maximize my profit for the current year. It's a very short-term goal. So if you look at wealth maximization, it's actually a long-term goal. It's a maintainable growth that you are talking of. So profit maximization, wealth maximization are definitely altogether different things. Profit maximization is basically a very narrow-minded approach, while wealth maximization is a broad-minded approach. Okay. Then of course, sometimes from a long-term perspective, wealth maximization is what works. If the company is totally focused only on profits, it will not be able to sustain. It will not be able to sustain in future, because just creating profits, it's like you may do some unethical activities, you may do some illegal activities, and you may make profits temporarily, but that's not going to sustain over long run. So our objective, which has been traditionally, we used to say profit maximization is the objective of every business. That's actually getting evolved, and now the new trend that we have in businesses is to create wealth or to create value. We see that many companies are making losses, still they are valuable, right? So if you look at any startup, the startup industry, most of them are into the loss-making areas, right? So they make losses. All these startups are actually making losses, and still they have got very attractive valuations, right? So if you look at Shark Tank, many startups are not generating enough profits, but they are definitely generating enough value, right? So if you simply look at it from the profit maximization perspective, what's the profit maximization? Profit, simply we know it's income minus expenses. The figure profit is actually a vague. Why vague? Because what is income, whether it is really my income, whether it is really sustainable income, whether really it is really maintainable income, that's something which is vague, because what is income and what is expense, that is subjective area, which is obviously bounded by some accounting rules, but rules need to be followed blindly. They may make sense or may not make sense in a typical business setup. So the profits are going to be like income minus expense, but how to compute an income and expense? For that, we have a typical set of standard, right? But those standards may provide a guidance as to what is measured, but again, it is subject to some sort of conflict on the whether it is income or income or not. So therefore, we say that the profit term as a whole is it's a vague thing, right? So profit term as a whole, it's a vague thing. It's not clarify what does that really mean, because it may be a total profit, gross profit, net profit, profit before tax, profit after tax. So there are many such types of profits, right? Thirdly, profit maximization should also be considering the risk. As I told you, you can maximize your profits by doing some sort of jugaad or doing some sort of activities which will give you quick profits. Okay, so but then you actually take a risk into consideration. You take a considerable amount of risk to generate profits by short-term means, right? So profit maximization should be also considering the risk that it contains, right? Then, as I said, profit is a very narrow term. It's not something for which the business is there, right? So profit is vague, means the profit figure that is arrived at, that is not clear. Whenever I say I want to maximize my profit, so I'm not sure whether I'm talking of I need to maximize my gross profit or net profit or profit before tax or profit after tax. So for that reason, we say that profit is vague. The term profit as a whole is a vague term. Okay. Okay, so profit maximization, we have this 4 simple areas to discuss, which is again about why profit maximization should not be whole of any business entity. Okay. Now, coming to the wealth maximization portion. Wealth maximization is, obviously we need to look at what is wealth. So wealth is basically present value of your benefits, present value of your future benefits minus present value of your future costs. So wealth is present value of benefits minus present value of costs. So when we say wealth maximization, it is simply what is the present value of your current benefits and compare it with the present value of the cost, and the difference is, so in future, whatever present value you create, whatever benefits you create, you take the present value of it, right? So take a total of present value of all your future cash inflows, you can say, and present value of your cash outflows. That should be your wealth. Now, if you want to increase the wealth, what should you be looking at? Of course, I should be looking at the present value of the benefits. Present value of benefits should be increased, and the present value of the cost should be aimed at its reduction. Present value of benefits should be increasing and present value of costs should be reducing, right? Can you tell me, how can I ensure that the present value of future benefits be increased? How can I increase the present value of my future benefits? If I want to increase my wealth, of course, I need to increase the present value of the benefits. So what should I do because of which my present value of benefits should be higher? Present value of benefits should be higher. What should I do? There are 2 things, guys, which you need to perform over here if you want to increase your present value of benefits. Point number 1 is increase the benefits. Increase the benefits, right? Whatever future benefits that you're trying to earn, maybe in the form of cash flows, maybe in the form of more subscribers, or whatever parameter you have, whatever cash flows through which you are going to generate value, increase those benefits, right? By providing better services to your customers, by giving a very good experience to your customers in the form of quality of goods or services, right? So try to increase those benefits. And secondly, which you need to do to increase the present value of benefits is reduce the rate of interest. Because see, if you're talking of present value, I know you guys are aware how to compute the present value, right? In your CA foundation, you might have learned something called as time value of money, and we know how to compute the present value. Right? So for that, we generally use a rate of interest. So if you want to increase the present value of benefits, you need to reduce your rate of interest, because if your rate of interest is lower, the present value will be higher, right? Because I hope you are aware that present value is the future value upon 1 plus I raised to n. So if you want to increase the present value, guys, if you want to increase the present value, the future value of cash flows should be increased, and also this rate of interest should be reduced. This rate of interest should be reduced. The present value should be increased, and future value, if you want to increase the present value, the future benefits that you're looking at, you should try to increase them in the form of greater customer satisfaction or greater sales or greater cash flows that you can generate, and try to reduce the rate of interest, or this rate of interest is basically your cost of capital. So increase the present value of benefits minus the present value of the costs. So whatever cost you have, you need to reduce the cost, and of course the rate of interest also reduced. So that's how you can create a wealth. So if I want to create wealth, a very simple way is I need to give the best satisfaction to our customers in the form of good services, quality goods and services, with of course after sales warranty and all such categories, right? And also the funds which I'm using to make those sales, they should be borrowed at a lower cost. Okay, so that's about first point, how to maximize the wealth. Then when we are looking at wealth maximization, guys, uh, we are going to consider a cash flow approach and not accounting approach. Now, why cash flow approach is better and not accounting profit is considered? Let's have a look at it. So suppose you make a sale of 10 crores, but you haven't collected money from it, right? You have made a sales of 10 crores, you haven't collected money from it. So of course, that's going to lead amount of debtors in your books. So you'll have a debtors of 10 crores in your books. For to make the sales, you have purchased 8 crore goods, but you haven't paid for it. So you have the creditors as 8 crores, and you have created a profit of 2 crores, which is showing as a reserve over here. Now looking at this very cute balance sheet and P&L, would you like to make an investment in this company? Look at this short balance sheet and P&L and tell me whether you would like to invest in this company. Would you like to invest in this company? Yes or no, guys? Would you like to invest in this company? Yeah? No? Why? Why are you not ready to invest in this company? If the owner of this company comes up and asks you that give me a funding of 10 lakh rupee, would you not give money to your to the owner? Will you give the money? Will you give money to the owner, or yes or no? You won't. There is no money. Exactly, sir. This is like, it's just a book entry, sir. Sales of 10 crores, there's a debtors of 10 crores. You have not collected anything. Purchase of 8 crores, there's a creditors of 8 crores. You have not paid anything. So this is just a book profit, right? Has the company generated any cash from it? No. So therefore we say accounting profit generation is not a criteria which you look for wealth maximization, what you look is the cash flow, right? What you look is the cash flow. So the cash flow should be coming in. So cash flow should be like the sale value. Of course, this whatever sales you have made, you should be able to collect it. You should have paid your creditors, and you should generate cash profits and not just book profits. And therefore, we say cash flow approach is to be used and not the accounting profit approach. Okay. Right. So it's more important to analyze a cash flow statement than just a profitability statement, because cash flow statement actually tells you how much money the company has generated. Right. Now, what do you mean by wealth or value? As I said, it's present value of benefit minus present value of the cost. That's simply, you can say number of shares multiplied by the market price per share, or you can say value of the company is the value of equity that it has and the value of debt that it has. Okay, so wealth maximization, it means you are going to increase the value of the shares. Ultimately, it's the value of the shares which will create wealth for yourself. Okay. Now, many startups that you have observed, are they making profits? If you guys are aware of the startup ecosystem that we have, are they making profits? No, sir. But still they have enough valuation. For that case, take the case of Byju's, take the case of Unacademy, take the case of Zomato, Paytm, or any such startup that you can think of. Are they making profits? Of course, no. But they still have the valuation attached to them running into thousands of crores, right? So how is that possible? What is your take on that? How is that possible that those companies are making no profits? Basically, they don't have even cash inflows also. If you look at the cash flows also, they have the negative cash flows, and still they have substantial amount of profits. Still they have the substantial valuation. So what gives them that huge valuation? What gives them valuation is the future of the market. Okay, so valuation is basically derived from the future thing, that if any company is currently not making profits, but it's into a market in which it can be a market leader and ultimately start making profits, right? So future valuation is something gets to the present value as of now, and that gives them a higher valuation to them, right? So cash flows are expected, but not now, but that's expected in future, right? For example, Zomato, they are banking on the fact that people will start eating food getting ordered from home. They won't prefer to go into the restaurants. So initially these startups actually incur losses to acquire the market, and once the market is ready with them, they then start charging the premium, right? So initially you might have seen Ola and Uber, both of them were giving you good amount of offers. They were giving a good amount of offers to take a ride on the cabs, and even the drivers were given substantial perks or rewards and sort of salaries. But as and when the market got used to this Ola and Uber, this radio taxi, they started reducing the discounts that they offered to the customers. They started reducing the incentives that they were giving to the drivers, because ultimately now they are generating profits. Now they are having cash inflows, right? So whenever we talk of valuation, it's not just your current profits, it's about the future possible profit. Okay, so it's about present value of future. So it's a present value of future. So if you say that your future is really bright, so even though if you're making losses as of now, doesn't matter. If you're having profits, you will definitely, if you're having profits in future, that is going to assign you a substantial value as of now. Okay, guys, so that was about the broad difference between profit maximization and wealth maximization. Okay. Also, if you want to simply come up with more, you know, benefit or more distinguish large amount of profit. The objective over here, profit maximization, is to generate large amount of profit. Here, the objective is to have highest market value of the shares. Right? The objective is to have highest possible market value of the shares. This is short term. This is long term. Risk is not considered. Risk is taken into consideration over here. Over here, time value of money is not considered. Just create profit for the current year and you are done. But value or wealth maximization is not something that is. So it's a risk is taken into consideration, and also the time value of money is given due consideration. It requires immediate resources, no clear relation between finance decisions and share price. So there is no clear relation between the finance decision and share price. Over here, it is easy to achieve, but this is going to be difficult because you have to sustainably work consistently to generate value. Profit is like one fine year you create a profit and next year you don't create profit. That's fine, right? But you need to work, or you need to create profits and cash flows on a consistent basis. So therefore, that's going to be a difficult task. Okay, let me see if there are any potential queries. Okay, expected high cash flow value increase because okay. Suraj, can you share this PDF after class? Yes, definitely I will. Sir, but when you're incurring profits, Goma is asking, Miss Goma Arora is asking, when you're incurring profits, you have cash flows, then you can easily give perks, discount, etc. Since cutting them off leads to negative publicity, loss in customers. Need not be, Miss Goma. Have people stopped using Ola and Uber because they no more give you incentives? Probably not, because the market has got adapted to this new normal of Ola and Uber. Right? So today, if anyone wants to go for a ride or go for some some place in a city, the first thing that they see is, are there any Ola and Uber cabs and autos available in the vicinity, so that they can simply buy it, or they can simply take a book a cab and take it and just move around, because the trend is changing. Now we are not looking at the area where we need to get down the street and then wait for an auto. That's a gone thing. People do still in the metropolitan areas, but then the first priority is to look for Ola and Uber, right? How wealth maximization doesn't offer clear relationship between financial decision and share price. There is no clear relation, guys. Darshan, there's no clear relation between finance decision and share price, because whatever decision you make for your company, whether that decision is really going to increase your share price or no, uh, that's not clear. Like if I make an investment into some new project, whether that new project is essentially going to generate substantial profits for me or not, or I can say whether it is really going to add value to my shareholders. Uh, the question is like open, whether it may add or it may not also, right? And therefore we say there is no clear relation between the finance decision and the share price. It may click sometime that there will be that your financial decision is being favored by your shareholders and the share price goes up. However, it may not be always, right? Is it clear? True? Fine. Now an important concept that we need to understand is that you cannot earn a high return with the lowest possible risk. You cannot earn a high return due to lowest possible risk, right? Wherever you go, if you want a higher return, you need to undertake a higher amount of risk. Risk and return go hand in hand, or what I can say is, if you take higher risk, the possibility of you generating higher return is good. If you take lower risk, then you are possibly going to be surrounded by lesser amount of return. Okay, so both risk and return have a positive relation in which higher risk will lead to higher return and lower risk will lead to lower return. Okay, so risk and return go hand in hand. Like a very simple example, if you have SBI and a cooperative bank, the rate of interest which SBI offers you on its FD, it typically ranges from 6.5%, right? Around 6 to 6.5%. But the cooperative banks may offer you a greater rate of interest, maybe around 7, 7.5, or even 8%. So there, the rate of interest is higher, but the risk that you undertake is also higher in case of cooperative, right? So now if I ask you, let's say RBI bond, okay, then we have ICICI Bank FD, then we have Reliance Industries Limited debentures, TCS shares. Where do you feel the risk is highest? Where do you feel that the risk is highest? Where do you feel that the risk is highest? Is it the RBI bond? Is it the ICICI Bank FD? Is it the Reliance debenture, or is it the TCS shares? Where do you feel that the risk is higher? TCS shares? I'm talking of only risk. Yeah, TCS shares, right? So of course the risk is high, or I can say this is the highest risk over here. So TCS shares are having highest risk, and of course the RBI bond has got a lowest risk. And where do you get the highest return? Where do you expect a higher return? Of course, in case of TCS shares, right? So approximately, if I just tell you the numbers, in the past, RBI bonds or the government of India bonds are giving you around 6 to 7%, not more than that. The average FD rate in the past for ICICI would have been like from 7 to 8%. Reliance debentures may be giving you 9%. But if you look at TCS shares in the past, it has given you somewhere around 12 to 15% per annum. So of course, there's a much observed volatility in TCS shares, and that gives us a highest risk to it also. I mean, the risk is also higher in case of the TCS shares, right? So that's a simple fundamental of finance, that if you want to earn higher profits, go for taking higher risk. If you can't take the risk, if your risk appetite is lower, then you need not invest in the shares as such. Okay, fine. Now coming to the next part, which is about the agency problem and the agency cost. Agency problem and the agency cost. Now, this problem or this typical cost actually comes in case of joint stock company. So joint stock company, it's a legal entity, it's a separate legal entity. So we have the owners who are actually taking the risk, which are basically the shareholders who put their money into this joint stock company. Okay, so the owners, risk takers, are investing money into the joint stock company, and there you have a manager who is going to manage it. So these are two separate entities, right? For example, if we talk of Infosys, who are the owners of Infosys? Owners of Infosys are basically the shareholders. Are shareholders really managing the company? Are shareholders of Infosys managing the company? No. There is someone called as CEO. Similarly, who's the owner of Apple? The shareholders of Apple, right? But who's managing it? The CEO. Who's the CEO of Apple? It's the Tim Cook, right? So in a joint stock company, it has got two entities. One is the owner, another is the manager. The owners are providing the funds, and managers are actually managing those funds or managing the business entity. Now, obviously, because of these separation of management ownership, because of this separation of management and ownership, there is going to be a conflict. There is going to be a conflict, right? Now, what sort of conflict we may have, right? So what sort of conflict we may have, because the objectives of both the entities, both the set of people are different, right? Now, let's say there is a investment that is being pondered on. So we have a project which requires an investment of 1,000 crores. There's this project which requires an investment of 1,000 crore, and this 1,000 crores are going to likely to have substantial profits. Likely to have substantial profits. Now, it is likely to have substantial profits, but there is a greater amount of risk. Now, just imagine yourself, you being the owner, and also you being the manager of the entity. You being a owner as well as you being a manager of the entity. Would you like to take greater degree of risk or lesser degree of risk? Being a manager as well as owner. So let's say you have a sole proprietorship. What would be your risk appetite? Would you really like to take more risk or lesser amount of risk? Of course, a lesser amount of risk, possibly whatever is the lesser amount of risk possible, we will like to take that one, right? But when it's a case of owner and manager getting separated, managers are actually not taking risk, but the operating decisions are being taken by managers. So would managers like to take greater amount of risk? Yes, they will, because they are not the risk takers, right? The consequences of risk are not going to be borne by the managers. The consequences of the risk are going to be borne by the owners. And that's the primary reason why there is going to be a conflict between these two set of people. The owners, being the risk takers, they would obviously consider that the risk should be minimum or risk should be optimum, but managers are least bothered about that. Managers say, we are not going to take the risk, right? Risk is going to be undertaken by the shareholders. So let us look for some risky areas and try to earn quick profits, right? So try to earn some way of quick profits. Like ultimately, the salary of the manager depends on the profits, right? If the company is making good amount of profits, the managers are going to get profits. Managers are going to get a kind share in the profit also. So the managers are going to have higher salary amount when the profits are more. But that short-term profits are actually undermining the long-term maintainability of the company value. So the project investment, when it is of 1,000 crores, that 1,000 crores, if that project is having a greater degree of risk, manager would say, let us take the risk because ultimately we are not going to bear it. The risk is to be borne by the owners. So let's simply take the risk, right? However, the owners may not be in that position. Owners wouldn't have taken it. Why managers are taking that risk? Because their salaries are dependent on the profits. Managers would always like to look from a short-term view, and owners would always like to look from a long-term view. From a short-term view, managers would like to take up some projects that are going to give you quick profits, need not be maintainable profits, because they will be like this. See, they are ultimately employees. So one fine year they make profits, they take the share of profit as a salary, and then they just move out of the company. Right? So that short-term objective is with the managers, whereas owners have a long-term vision, and therefore there's going to be a conflict. So now, because of this conflict, the company is ultimately going to suffer. So how do we ensure that both the things are taking equivalent position, or I can say both managers or owners are having a single, uh, vision? Some of the way is to, link the salary to the share price. Because see, the company share price are going to increase only when the company is generating substantial value and not profits, right? So link it to the share price and not with the profits. Secondly, compensation, whatever that you give, it should be partially linked to the profits. If you earn some X amount of profits, then this will be the incentive, and to the long-term results also, right? So for example, if we say that if you earn profits, you get some commission, but then if loss happens in future, you will have to pay back the commission, right? So long-term results as well as short-term possibilities needs to be looked at, and these are the two classical ways of resolving this agency conflict or agency problem. So this agency problem and agency costs are basically going hand in hand. To uh, remove that agency cost, or to remove that agency problem, you need to incur cost in the form of salary linking to the share price and compensation linking to the profits, partially, and long-term results in a other partial sense also. Okay, is this clear, guys? The agency problem and how do we solve this agency problem? Yeah. Okay. So the next part is about the sources of funds, guys, and for which I have this entire chart available for you. So this is a very comprehensive chart in which you can just zoom in and look into the entire details. So I have basically compressed the entire sources of funds chapter into one single page, and I'll be definitely sharing this post our session today. I'll begin with this sources of funds after a short break that we take right now. So let's take a 10 minutes break, and after that we'll start discussing about the sources of funds, which is the second chapter of our financial management. So let's take a break of 10 minutes, guys. Since it's a theory topic, I would like to give you a 10 minutes break, and then after that we'll resume back with more discussion about it. Okay, welcome back guys after the break. Let me see if you have any queries. Okay, great. What's the meaning of venture capital? We'll discuss that, Bhumika. We'll discuss what is venture capital surely. Okay, let's get started with this topic of sources of funds, guys. Okay, so when we say source of funds, we have initially uh, seen the various sources of funds, the broad categorization of sources of funds. What are the two categories of sources of funds? What are the two categories of sources of funds? One is the owned funds and other is the borrowed funds, right? So that's how I have drawn this chart, and we have this owned funds over here. Correct? We have this owned funds over here. In the owned funds, you have some domestic sources and international, and same goes even for the borrowed funds. So even in the borrowed funds, you have domestic and the international sources. So let's first talk about owned funds, and then we'll go for the borrowed funds. Even in the case of owned funds, what we have is domestic and international. In the domestic, you have two further classification: external sources and internal sources. So external domestic funds and internal domestic funds. We'll talk about internal. Whatever is the retained earnings, that is whatever profits you generate, flowed back by the company into the business, the profits which you don't distribute it to your shareholders, like undistributed dividends, undistributed profits, that belongs to the shareholders, and obviously that adds to the value of the company. Coming to the other part, external sources, you have two sources of funds. One is the equity share capital and preference share capital. So let's discuss, let's have a broad overview of what do we have in the equity share capital. In the equity share capital, we say that it is permanent capital. Equity share capital is a permanent capital which don't change, right? So equity share capital is essentially a permanent capital which don't change. Once you raise equity, it's very less likely that you will buy it back. In a very rare scenario, the companies undertake buyback, right? So of course it represents the ownership. Thirdly, it's a residual interest in income and assets. Since they are the owners, after all the expenses are paid, like after all your salaries, after all your interest, taxes, and everything is paid, after that, whatever is left out in the end, that's what the residual interest is, right? So they have the residual interest in income. So when it comes to income, they are the last person to receive the income after all the interest and taxes being paid. And also when the company goes at a liquidation, even the realization from assets are going to be the last one to be received by the equity shareholders. Equity share capital, understand it has got the highest cost of capital. Okay, equity share capital has got the highest cost of capital. Remember, equity shareholders are your owners, right? So equity shareholders are the owners of the company. So the owners have got the highest cost of capital. Owners are having the highest cost of capital, which means equity share capital denotes that they want the highest possible return. Now, there's this point wherein you may argue that, sir, equity shareholders need not be paid any dividends because there is no mandate, there is no obligation on the company to pay dividend. Right? There is no mandate, there is no obligation on the company to pay dividends, right? And for that reason, equity share capital should be having no cost at all, right? But no, it's not that like that, guys. See, equity shareholders are the owners, and owners take the highest possible risk, the highest risk in the entity. And as we look into the financial funda, high risk means they require high return. So what if the company doesn't generate enough profits or enough returns? What would happen if the company is not generating enough profits or enough returns? Tell me. What would happen? The shareholders will dump the shares in the market and just get away with that company. And ultimately, the company will lose the value. If the company is not generating enough cash flows, the shareholders are not interested to be remaining shareholder of the company. They'll dump the shares in the market. The valuation of the company will go down. Right? And therefore, that's the very great amount of risk that the company has. Right? So if they're not performing, the value loss is going to be very substantial, and that's a very high cost. Right? Then it provides security to other fund providers. Remember, the company with higher degree of equity share capital, the company with highest degree of equity share capital, the company with highest degree of equity share capital is going to provide security to the fund providers. It will provide security to the fund providers. Basically, if you want to go for a loan, if you want to take a bank loan, the banker will ask what is the contribution of the owners, right? How much funds have the owners put in? If the owners have not put in substantial amount of profits, substantial amount of funds, if the owners have not put a greater degree of capital, the bankers will say we will not fund you, right? Because bankers say that okay, we will give you 70% loan. The balance 30% has to be by the owners. If the owners are going to contribute, let's say if you talk of this 70-30 ratio, right? So if I say that the ratio is like 70-30, which the bank is going to fund 70 and the balance has to be by equity. So if equity shareholders are putting, let's say 3 crores, bankers will be ready to give 7 crore loan. If the owners put in 30 crore, bankers would be ready to pay 70 crore. So higher the amount of equity share capital or higher the amount of equity, greater will be the position for the outside fund providers to give you additional loan, right? And therefore, this is the point that we talk over here, that it provides a security to other fund providers. Higher amount of equity share capital, it means you are having owned funds to a greater extent and lesser borrowed funds, and therefore that is a security. Like, so any bank would like to put money in a project where a substantial chunk of money is coming from the owners. Okay, some of the advantages that we say: permanent and irredeemable. It increases the financial base and help facilitate additional borrowings. As I said, 3 crores against 3 crores you can get 7 crores, against 30 crore you can get 70 crores. So higher equity share capital will ensure that you can get a greater degree of additional borrowing also. There is no obligation to pay dividend, and also rights issue are made by the company. I hope you're aware about rights issue. Can you tell me, guys, what's a rights issue? Can you tell me what's a rights issue? Sweat equity is basically the equity shares which are given to the management, to the managers of the company for their hard work which they put for creating the company value. Yeah, guys, tell me what's a aware. Rights issue is basically the shares which are issued to the existing shareholders, and these shares are issued at a discounted price as compared to the market price. Okay, so that's a rights issue. In terms of disadvantage, we have the dividend income is taxable in the hands of the shareholder. Whatever dividend the shareholder earn, that's actually a profit on which tax has been paid by the company. But now, since the shareholder is getting, shareholder has to pay tax on it. Then it's a risky investment, sir. Whenever you talk of rights equity shares, it's a risky investment. Whenever you issue more equity share, your earnings per share will reduce. Okay, and dilution of ownership and control. Now let me just explain this to you. Let's say earlier you had a profit after tax of 100 and number of equity shares you had, let's say 50. So what is the amount of EPS that you have? 2, right? So 100 divided by 50, 2. So PAT is 100, number of equity shares is 50, and EPS is 2. Now, let's say with the same PAT, you go for issuing more equity shares. So you issued another 50 equity shares, and now you have like additional 50 shares being issued. So now your EPS becomes 1. So if you issue more equity shares, earnings per share is going to get diluted, right? Earnings per share is going to get diluted. Mr. A Mr. A number of equity shares. So we have a PAT of 100. Mr. A owned, let's say 10 equity shares. So what is the percentage holding? How much control, how much percentage holding does Mr. A have? What is the percentage holding of Mr. A? Out of 50 shares, he is holding 10 shares. So what is the percentage holding of Mr. A? Can I say 20%? Right? Now when additional 50 shares are issued, Mr. A is still holding those 10 equity shares. Now what is the percentage holding? Because now the number of equity shares has increased to 100. So what Mr. A is having still that 10 equity shares. So what is the new percentage holding? Can I say 10%? So Mr. A is holding the same number of shares. Mr. A is holding the same number of shares. But when the company issues additional shares, can I say his stake gets diluted? His stake gets diluted. Am I right, guys? So I hope these 2 points are pretty clear to you, that there's a reduction in EPS and there's a dilution in ownership and control. Are these 2 points? Because these 2 points are typically the point which are of contention, where students find it difficult, sir, what is this number? So I hope reduction in EPS and dilution of ownership and control points are clear to you. Yep. Fine. Now coming to the preference share. So preference share is basically a hybrid form of financing. Preference share capital is a hybrid form of financing. Okay, so preference share capital is a hybrid form of financing in which they are owners, but you need not think them to be a shareholder, because you have an obligation to pay them dividend. So obviously the rate of dividend that you pay is going to be higher than the rate of interest. Can you tell me why do we have the rate of dividend higher than the rate of interest? Why are preference shares? Why the preference shares should be given a higher rate of dividend than the rate of interest on debentures? Can you tell me why? Yeah, guys, tell me. Can you tell me why the rate of preference dividend is supposed to be higher than the rate of interest? Yep. Tell me. Anyone? Because they take higher risk. See, ultimately they are preference shareholders. So they are preference shareholders. It means they are in one form or the other the owner of the company. So if they are owner, the rate of dividend is going to be higher. If they are owner, then the rate of dividend is going to be higher. So rate of dividend is going to be higher than the rate of interest. Okay. Preference share can be cumulative, non-cumulative, redeemable, participating, non-participating, and also convertible. So let's talk about each one of them. What's a cumulative preference share? On which the preference dividend keeps on accumulating every year. So if in one particular year you didn't pay preference dividend because you don't have profits, that gets carried over to the next year. That's called as a cumulative. In case of non-cumulative, if in one fine year you don't have profits, you don't pay dividend, that dividend doesn't get accumulated to the next year. Then the preference shares can be redeemable, or I can say they can be redeemed for cash, or they can be redeemed for shares also, or you can say those are basically convertible. So you can get your preference share converted. You can get your preference share converted to equity shares. That's your convertible. And if it's redeemed for cash, you will get cash against the redemption of the preference share. They can be participating or non-participating. Let's understand what is participating and what is non-participating. Preference shares are offered a typical rate of, a typical rate of dividend, right? So let's say you have 9% preference shares. So what does that mean? 9 rupee preference dividend will be paid. That's it. If that's it, then it's a non-participating thing. Okay. Then if I say that, okay, 9% preference share plus 2% of profit if profit is more than 100 crores. 9% preference share plus 2% of profit if profit is more than 100 crores. So what's the difference between these two now? Sir, over here you have only 9% preference dividend, wherein per share you're going to pay 9 rupees, that's it. So it's a non-participant. But here, if you are making good profits, if you're making good amount of profits, then 2% of the profits in excess of 100 crores also need to be paid to the preference shareholders. So essentially, these preference shareholders are participating. These preference shareholders are participating in. These preference shareholders are participating in the profits of the company, and therefore they are said to be the participating shareholders. Okay. Advantages. Some of the advantages that you have: if you issue preference share, dilution in EPS doesn't happen. Then you have an advantage of leverage. Now this advantage of leverage, as of now, I cannot give you an explanation, guys, because for that you need to understand what is a leverage in the ratio analysis chapter. So I'll let you know what is this advantage of leverage, or what is this advantage of trading on equity in the chapter of ratio analysis. If you issue preference shares, there's no risk of takeover. That is, if someone is having 100% stake of your preference shares, that is not going to have a ownership on the company, right? So dividends are fixed and pre-decided, and they are redeemed over a specified period of time. Then preference dividend, whatever you pay, that is not tax deductible. That's a disadvantage for the company. And cumulative preference shares is an obligation on the entity that even if you are not making profits now, the obligation is not here. You need to pay it back in the next years, right? Okay. So as I said, I'll not talk about this leverage term as of now. We'll discuss this in the ratio analysis chapter, because if I go ahead and explain this leverage, we won't be able to cover the topic as such. Okay, so I'll definitely touch upon this leverage point when we are doing the ratio analysis chapter. Okay, guys, so let's go ahead with the international sources of owned funds. That's your global depository receipts, in which you may have American depository receipts or Indian depository receipts. Now, what are these American Depository Receipt or GDR, let's have a discussion with the help of this example. Okay, let's look at this example. In India, we have, let's say, a company named Infosys. Okay, so we have this company named Infosys in India, which is looking for getting money from the US market. It is looking for the possibility of raising money from the US markets, and for that it will have to approach the US market. Now, if Infosys takes its shares directly to the US market, if this Infosys takes the shares directly to the US market and starts selling in the US market, US stock exchange, just below the US stock exchange, New York Stock Exchange, let's say on the Bull Street, this Infosys managers are trying to sell the Infosys shares. Do you think anyone is going to buy those Infosys shares in US? Of course, no, because those Infosys shares has got they've got no legal backing in US. In US, they just have got no legal backing in US, primarily for a reason that they don't make any sense, because we buy shares in India because they are recognized in Indian stock exchanges. But Infosys shares, even there, the denomination would be rupee, and no one would be interested in buying the Infosys shares, even if they know what is Infosys. Okay, so Infosys has to follow some route, some procedure by which you can get money from the US market. So what Infosys does is it gives shares to a depository in USA. It gives shares to a depository in USA. Now, who is a depository? Can you tell me who are the depositories in India? Can you tell me, guys, who are the depositories in India? Anyone? By the way, do you know who a depository is? Basically, a depository is a bank of shares, or it is the entity which stores all your shares in dematerialized form. So depositories are basically those entities which keep your shares in dematerialized form. Like, for example, you go to bank, you go to ICICI Bank, you deposit a lakh rupees into your bank account, and you can just log into your net and you can observe that on the screen the amount is shown, right? Rupees 1 lakh deposited and the balance is so and so. It doesn't show you the bunch of money which you deposited over there, right? It works on the simple principle. So a depository is also like that, which is going to give you details about how many shares is the depository holding. How many shares is the depository holding for you? How many shares of which company? Right? So that's a typical depository that we are talking about. In India, we have two depositories. One is the NSDL and the other is a CDSL. So these are the entities who store the shares of all the Indians in dematerialized form. Right? So you may be the shareholder, but shares are actually held in CDSL and NSDL. For example, if you have money, you are the owner of the money, but who is holding that money for you? The bank. Right? So in the same way, depositories are the entities who are holding or who are storing the shares of the companies in dematerialized form. So in USA, you have this depository. In USA, you have this depository to which the Infosys gives shares. Infosys gives shares, let's say 10,000 shares are given to depository. And now the depository, the US depository, is going to issue depository receipt for that. So US depository is going to issue depository receipt. What sort of depository receipt? So it's just going to tell you that, okay, so we have received 10,000 shares from the Indian company Infosys, and 1 depository receipt for each 100 shares. Now, this depository receipt, since it is issued by a US entity, will it be a legal document in USA? Yes, it will be a legal document in USA, right? Because it's issued by a depository in US, and those depositories are issued in the US market. Now the investors will say, okay, so this has got a legal backing because this is issued by a US depository, and they'll pay dollars to buy it. They'll pay dollars to buy it. And those dollars are going to be passed on to RBI, and from RBI, Infosys will get it converted to rupee. So ultimately, the money that is raised by Infosys, it is from issue of shares. But then remember, it is from issue of shares, but those shares are not issued in India. They are issued in US market. And these depositories that are issued in US market are called as American Depository Receipt. If it is issued anywhere else, like in Europe or in Japan or in Australia or in UK, wherever you say, those are all together, the entire bunch is called as American Depository Receipt. Similarly, if any foreign entity comes and issues shares in India, that will be called as Indian Depository Receipt. Okay, I hope this depository concept is clear to you. Is this depository receipt concept clear to you guys? Is it clear to you? Depository receipt concept? Yeah. Is this absolutely clear how the funds are raised from the overseas market? Yeah, guys. I'm just seeing whether there any response. Yeah. All clear? Perfect, perfect, guys. Great. So here we have this international sources. You have like GDR, ADR, and IDR explanation on your way. Now, I want to specifically highlight an important concept because I may not be able to cover this entire chart in detail, right? So it's important that we can we can focus on some of the core concepts, and also, of course, as far as possible, I'll try to cover up everything. But in case if we miss out something, that shouldn't be hampering us, right? Okay, so let's look at this concept of securitization as of now. Okay. Some queries. Foreigners has to deposit in NSDL or CDSL. Yes, Suruchi, you are correct. Any other country or issue depository receipt called as ADR? No. If you issue in US, that's called as American Depository Receipt. At a global level, the super name, the universal name is Global Depository Receipt. Wherever you issue that issue those receipts, that country gets the name, right? European Depository Receipt, Australian Depository Receipt, England Depository Receipt. But the global name, the universal name is the Global Depository Receipt. Okay, fine. So let's discuss about this concept, very interesting concept called as the securitization, guys. Okay, let's discuss this securitization. Okay, look at this. So we're talking of a bank, let's say State Bank of India. It has got in its assets the loans and advances granted, right? So the amount of loans and advances that are granted are there in the asset. Now these loans and advances are given for various purposes like home loan or credit cards or you can say any auto loan or any industrial loan, right? So all those loans and advances are assets of any bank. So let's say a typical example in which SBI is looking for a home loan portfolio, that is a bunch of home loan borrowers with a principal outstanding of 1,000 crores, and we are charging them a rate of interest of 9%. Okay, so this entire 1,000 crore is blocked at 9%. Entire 1,000 crore of SBI is blocked at 9%. And now SBI is looking at avenues to make this a liquid thing. That is, it's looking at to liquidate this home loan. Now, if I want to get cash for this home loan, can I ask the home loan borrowers to make the payment on time? That is, to make the payment early. Can I ask them to make the payment early? I have granted them loan for 20, 30 years, but then now can I just one fine day I go ahead and ask them to make the payment full? No, that's not possible because you have promised them a term of 20 to 30 years, so you cannot ask them the money in full. So these are the home loan borrowers, and now SBI is looking for some ways to get them encashed. Okay, so get them encashed in a form that how do we go about this encashment? The only possible way is to transfer this loan to someone else. Correct? SBI will say these home loan borrowers will be transferred to some other entity. That some other entity will get the interest and EMI from the home loan borrowers, and SBI will get a lump sum money against that. So for that, what SBI does is an SPV is created. Right? So in SPV, in SBI, we have the that is being created. So SBI, we have the SPV being created. That SPV is a separate legal entity. It's a separate company, and that SPV has got a task of liquidating this home loan. So SPV goes to the public at large. So the SPV, it goes to the public at large, and it asks from the public that it needs some money. So SPV goes to the right. So all the investors with money are sitting in the market, and SPV actually asks for money from them. SPV asks for money from them. So from the public, the SPV is asking money. So now, when the SPV is asking money, the public in its whole is going to give some amount of money to SPV. What SPV will do is SPV will issue bonds. Right? SPV is going to issue bonds to the investors. These investors are going to subscribe to the bonds of the company, and against which they are going to give money to SPV. But what are these bonds backed by? Because there has to be some legal backing of the bonds, right? There has to be legal backing of bonds. So SPV gives them a detailed information that, see, I am going to take over the entire home loan portfolio of State Bank of India. It means the entire home loan chunk is going to be transferred to me, and I am going to collect EMIs from them. I'm going to collect interest from them, and whatever income or interest that I generate, that will be passed on to you, right? So SBI, with a principal outstanding of 1,000, transfers this home loan to SPV, against which the SPV gives, is going to give some value to the SBI. Let's say it gives 990 crores. Even though the principal outstanding was 1,000 crores, the SPV gives them 990 crores as a settlement, because SPV does a credit analysis. It performs a credit analysis of the home loan portfolio, in which it just tries to look for, what is the rate of interest being charged, how many of them are really going to be the good home loan borrowers, how many of them are not going to pay, and based on some sort of analysis, it says that we'll pay 990 crores settled. So SPV gets the portfolio and it gives 990 crores to SBI. SBI State Bank is now, it's like it has transferred the risk to SPV. Now this SPV collects the money from the bonds. So let's say it collects 990 crores. It collects 990 crores from public, right? So SPV is a special purpose vehicle. It's a special purpose vehicle or an entity created for this purpose. It's a separate company created for this purpose. So this company raises 990 crores from the public, and it passes on to SBI. It gets the home loan access easily, right? Now, of course, what's the rate of interest that SPV is going to earn from the home loan of SBI? That is 9%, right? And what's the rate of interest that SPV is going to transfer to the investors? That's actually going to be interest at the rate of maybe 8%, right? So that may be just transferred by way of 8%. So interest is going to be paid at 8%. Interest is going to be paid at the rate of 8%. So transfer over here by 9%. So 1% is kept by SPV for its own purpose for managing its expenses, and balance 8% is transferred to the public. Of course, this is going to sail through only if the bonds are purchased by the public. If the public is not in the form, or I can say if the public is not buying the bonds, then this setup cannot be undertaken, right? Can you give an example for SPV, Darshan? I hope, Darshan, you are aware of HDFC Limited and HDFC Bank. Are you aware of these two? HDFC Limited and HDFC Bank. How can public trade in IDR? Just like you buy shares, you can buy the IDR also. But in India, as of now, we don't have any IDR issued. Okay. If you would have been in US, you might have seen the ADR of Indian companies. Okay, yeah. Darshan, have you heard these two names, HDFC Limited and HDFC Bank? Yes, yes. Okay, so HDFC Bank is the home loan portfolio owner, and the home loan portfolio is transferred to HDFC Limited. HDFC Limited is a NBFC. This is a non-banking finance corporation. It's not a bank. It's a non-banking finance corporation which raises money through debt. Debenture holders, debt. From that, the money is raised, and against which you have, when you raise the money, that money is transferred to HDFC Bank, and the loan portfolio is transferred to HDFC Limited, right? So it's like one such typical case. Is SPV related to SBI or completely separate? It is related because it is going to be created by SBI itself. It will be created by SBI as a separate entity, as a subsidiary sort of thing. Okay. I hope this securitization concept is clear to you guys. I would recommend you to look for a video of subprime crisis in YouTube. So after today's class or anytime later, you can actually look for a YouTube video on subprime crisis. You'll get an idea what detailing goes into this securitization process and how the securitization process has actually led to a crisis or a financial fiasco in the entire world. Full form of SPV, Mohit, I think I have written it. Yeah, it's special purpose vehicle. Okay. Is the securitization concept clear? Is the securitization concept clear, guys? Yep. Great. Is it making of security liquid? Not security liquid, but a loan portfolio is getting a liquid, because now SBI will have 990 crores with it, which it can use for various other purpose now. Right? Okay. Next thing is we need to understand the difference. Why this SBI is creating a SPV, or what is the advantage of this SPV? Can anyone tell me why would SBI create a SPV? One is definitely to get a liquidity, to get this 990 crore as a cash balance, as a bank balance. But apart from that, what is the other advantage which SBI has if this securitization process is undertaken? And the question arises, sir, why should a SPV be created? Why can't SBI itself issue bonds? Yeah, because these bonds can be purchased by general public. It may be a case one of the home loan borrowers is also a general public, right? Right. So can you tell me why a SPV is created? Anyone? Raising of funds, that's okay. But the most important aspect is, to hand over the risk, to transfer the risk. Suppose this securitization was not undertaken, and if any of these home loan borrowers defaults, then if any of these home loan borrowers is defaulting, can you tell me what would be the situation? Can I say it will be the loss of SBI, right? Right? It will be the loss of SBI. Now, if any of these home loan borrower defaults and SBI itself has issued, let's say, bonds. If SBI itself is issuing the bonds, and if any of these home loan borrower defaults, the public is going to catch hold of SBI and say that you have to give the money to us. But when you give that loan portfolio to SPV, the entire loan is transferred to SPV. Now, if anything happens to this home loan portfolio, if anyone from this home loan portfolio, home loan borrowers defaults, it's the SPV which has to undertake the risk, and the public will catch hold of SPV and not SBI, because SBI has transferred the risk. Because understand, giving loan to anyone, it's like undertaking a risk. Unless and until that person has paid you back the money, it's like you're holding the risk. Right? So if you're holding that risk, that's a problem. And if any one of these defaults, there will be an NPA which SBI have to handle. So SBI just want to get rid of this NPA problem, transfer the risk to the other entity. Okay. Is it clear, guys? Fine. So that was the process of securitization. Now, one important aspect that we need to know is what's the difference between a floating rate and a fixed rate bond. Let's try to understand it with the help of some example. Normal bond. This is from the investor's viewpoint. From the investor's viewpoint, let's say a debenture is issued. Okay, so let's say a debenture is issued from a normal investor's viewpoint. In year 0, 1,000 is paid. I mean, as an investor, I pay 1,000 rupee, and then I get 90, 90, 90, 90, and then finally in the fifth year 1090. So over here, whatever interest I am getting, that is fixed. Whatever is the amount of interest that I'm getting, that is fixed. So it's a fixed rate bond. What happens in case of floating rate bond? In case of a floating rate bond, the rate of interest fluctuates. So for example, let's say a company issues a bond with a term that the rate of interest will be RBI repo plus 3%. So if it's like RBI repo plus 3%, what does that mean? As the RBI repo changes, the rate of interest that you get is also going to change. So in year one, let's say repo was 5%. So what will be the interest that you are going to get? It will be 5% plus 3%, that's 8%. In the second year, the repo became 6%. Now the rate of interest that you're going to get is 6% plus 3%, which is 9%. In the third year, repo, let's say it becomes 5.5%, then it becomes 8.5%. Fourth year, when the repo becomes 7%, then it becomes 10%. So the rate of interest that you get, or the amount of interest that you get, that is essentially dependent on the RBI repo rate, right? It may be dependent on RBI repo rate. It may be dependent on some other rate or some other benchmark, we say repo, reverse repo, or treasury bill rate, the bills which are issued by the bank. So that is going to be a differing thing, right? So the amount of interest that you get, it keeps on changing, and therefore that's what we call it as a floating rate bond. So I hope you got the difference between floating bond. Understand that in case of a normal bond, in case of a fixed rate bond, you are not going to be affected by any change in the RBI repo rate. But in case of a floating rate bond, you find that the rate of interest and the amount of interest that you get, that gets fluctuated, that varies. Am I right, guys? Did you get it? Did you get it correct? Right? What is repo rate? I think you guys are aware about what's a repo rate, right? Repurchase rate of RBI. You're aware, right? Yes or no, guys? You're aware, right? Yeah. Okay. So that's the difference between a floating rate and a fixed rate bond. So that will be needed in our further discussion. And so I just thought that let me just discuss it with you first. Okay. So borrowings. When you want to do borrowings, you may have domestic sources. You can see I have created a distinction for this in the domestic sources. In the domestic sources, you have this entire thing. Seed capital, right? So domestic sources, in that first we have seed capital. Seed capital, if you see, understand that seed is whatever you pay to start a business, right? So this seed capital is basically issued by, or this fund is given by IDBI, Industrial Development Bank of India, for the startups. When it comes to startup, they don't have substantial profits. They don't generate much of cash flows, and whatever amount of interest that IDBI can charge is going to be nominal, right? So seed capital is generally interest free, but it carries a service charge of 1%. So just for first 5 years, it gives you money at 1%, and then it starts increasing, because for the initial years, the startup may not have profits. So it gives that comfort zone that you just have to pay the 1% of the capital. And later on, when the company starts making profits, then you start charging them a rates at a higher rate. Repayment and rate of interest charge depends on the repaying capacity after a moratorium of up to 5 years. Right? So this is a seed capital. Sometimes the companies can also issue zero coupon bonds and also deep discount bonds. Now, generally when the bonds are issued, they are like this, as we discussed. Fixed rate bond, that is, today you pay some money, the company pays you interest at regular interval, and then the final redemption. Instead of that, we can also have bonds in which issue price is 10 rupee and the face value is 100. It means deemed after 30 years. So you pay 10 rupees and the company will pay you back 100 rupee after 30 years. You pay 10 rupee now to the company and the company will pay you back 100 rupee after 30 years. So this is a case of zero coupon bond. It means there are no coupon. There is no interest payment that is happening at installment or regular interval, but you get a higher amount directly on the maturity. Okay, moratorium. Mohammed, moratorium means no need to pay any installment in that time frame. Okay, in that time period, you need not pay any installment. Right, so EMIs are not happening at that time. Okay, so that's a zero coupon bond, and if they are issued for a very huge amount of discount, like in this case, issued at 10 and redeemed at 100, it means 90 rupees the discount. You are saying it's a deep discount bond. So deep discount bonds are basically a type of zero coupon bonds. Okay. Then the other thing that we can discuss is about secured premium notes, SPR. What are these? These are also redeemable. These are also redeemable notes. Notes means it are redeemable bonds only. Okay. Notes means redeemable bonds. So redeemable notes issued along with detachable warrants. They are issued along with detachable warrants. Now, detachable warrants means in those debentures, there is a warrant which is attached. Now, what's warrant? Warrant actually gives you the right to get the shares of the company at a fixed price, right? So if you talk of secured premium note, it is somewhat like this. See, secured premium note with a detachable warrant. Okay, so this is like a normal debenture, or what you call it as a note, right? And over here you have the warrant. Now, what is a warrant? Warrant means it gives you a right to buy share at rupees 10. So this is actually giving you a pre-decided right to buy the share of a company at a price of rupees 10. It gives you a right to buy the share at a pre-decided price of 10 rupee. So 10 rupee ka share price, the shares are issued at a pre-decided price. So this warrant needs to be detached, that needs to be teared from the debenture and presented in front of the company, against which the company will issue you shares for a respective price, and warrants need to be converted within time period notified by the company, which is usually 4 to 7 years, right? So these are like convertible sort of debentures, you can say. Then the unsecured loan, the long-term loan which can be provided, is also by the promoters. The owners themselves can give loan to the company, right? And that is called as a quasi-equity. That's a quasi-equity where the owners are actually giving loan to the company. Okay, so that's the unsecured loan from the promoters. These are also called as a quasi equity. What's the difference between deep discount and zero coupon bonds? Darshan, zero coupon bond and deep discount bond are one and the same, but in case of deep discount bond, the gap between the issue price and face value is higher because the term is more. If it is issued for a lesser number of term, then it will be just a zero coupon bond and not a deep discount bond. If the term is like for 5 years or 3 years, then there won't be much gap between the amount that you invest and the amount that you realize. So there is a discount, but not deep discount. Okay, fine. So that's the secured premium note and the promoter loan. Then you can get the money from commercial banks through short-term funds. Also, floating rate bonds can be issued. Debentures can be issued, which can be vary from 300 from 3 to 100 years. Then sometimes the bonds that you are issuing may be inflation bonds. Now, what are these inflation bonds? Let's try to understand that. Inflation bonds are the bonds in which interest rate is adjusted for the inflation. So for example, if interest rate is 11% and inflation is 5%, the investor will earn 16%. Therefore, investor is actually protected against the inflation. So these are inflation index bonds. As you see that the inflation is growing in the market, the bonds offer you a higher rate of interest. If the inflation goes down, the bonds will give you a lower rate of interest. So basically, you are getting protected, you're getting yourself protected from the inflation. Okay. Then the other things, other sources of funds which can be used. Yashika, what are you asking? It could be fully dependent on fluctuating rate or combination of both, in which one is fluctuating and other is fixed in case of fluctuating bond. In case of fluctuating bond, Yashika, as I said, it will depend on some benchmark. That benchmark can be RBI repo, reverse repo, India's GDP growth rate, foreign exchange rate, anything. Okay, so it is dependent on that. So it will be like some RBI repo plus something or minus something. So as the repo fluctuates, the rate of interest is offered to you, that also gets fluctuated. Okay, so other short-term sources of funds, guys, it can be advance from the customers. You can get the money in advance from the customers. That also acts like a short-term source. You can get trade credit from from your creditors. You can get the goods on credit. Similarly, some unearned income, you may get it earlier. The other short-term source is the commercial paper. Commercial paper. It's a commercial paper means it's having a yield, or I can say the tenure is less than 1 year, and it's an unsecured money market instrument, right? So unsecured money market instrument, it is a form of a promissory note, and these are issued. These are issued generally by the highly rated corporates or any all India financial institutions. The denomination is like 5 lakhs or multiples. So each commercial paper is for 5 lakh, 10 lakh, 15 lakh in that way. And the rate of interest is generally linked to the 1-year government bond. And for the commercial paper, they need to mandatorily obtain credit rating for their paper. Okay, so commercial paper need to obtain mandatorily credit rating. Treasury bills are the sources of funds for the government, because the government gets the funds for a period of like from 14 days to 364 days, and the bonds that are issued are called as the treasury bill. The certificate of deposit is a document of title which is similar to a time deposit receipt issued by the bank, except that there is no prescribed interest rate on such funds. It is traded in the secondary market. Right, so certificate of deposit, it's a time deposit receipt issued by a bank. Remember, commercial papers are issued by the financial institutions or by the corporates. certificate of deposits are issued by the banks in the public. A company can also take public deposits, basically debentures that the company issued. And there is also stipulation with regards to that. In law, you are going to learn that about 35% of its paid up capital can be raised from the public deposits. There may be intercorporate deposits also. Now, what do you mean by intercorporate deposits? One company depositing money in the other company. So that's your intercorporate deposits. Then you will have the overdraft and cash credit also. I hope you guys are aware about the overdraft thing. Overdraft is like customers are allowed to withdraw in excess of the credit balance in the current account up to a fixed limit. They are repayable on demand, but generally continue for longer period. And cash credit is also similar. The difference between overdraft and cash credit is overdraft is attached to your existing current account, whereas cash credit, it is that cash credit is there for a separate account is created. And of course, for cash credit, you need to have some hypothecation of your current assets. So there needs to be some mortgage, some hypothecation that should happen to obtain a cash credit. Similarly, you can get the bills, right? Bills purchased or discounted. That's also a short-term source of fund. Okay. Then some specific type of bonds that we would like to know is a Yankee bond. So Yankee bond is issued by a non-US bank and corporation in US in terms of dollar, right? So let's say being a Indian company, I want to raise money from US. So I will go to US and issue bonds in US in dollar terms. That will be called as Yankee bond. Similarly, when a non-Japanese company goes to Japan and issues a debenture which is denominated in Japanese yen, right, that's called as a samurai bond. Similarly, if you do it in UK, that's called as bulldog bond. Now, a quick query to you. Tell me which country would be having maple bonds? Which country would be having maple bonds? Yeah, tell me. Which country would be having maple bond? Yep, maple bond. Maple bonds is by Canada, guys. Canada. So when you go to Canada and get money from there, that's called as a maple. That's issued by maple bonds, right? So Indian bonds are basically your masala bonds, but these are not typical in that sense. These are the bonds issued outside India, but which are denominated in Indian rupee. Okay. Some of the other bonds that you can issue from the market is like a very foreign currency convertible bond, which is a very low rate of interest, can get the foreign currency at a very low cost. Convertible floating rate note, which is an option to get it converted to a long-term debt security with a specified coupon. Protection against falling interest rate. Capital gain is not applicable in this case. Drop lock bonds are the floating rate bond, which would automatically get converted into fixed rate bond if interest rate falls below a predetermined level. So drop lock bonds is like your floating rate bond will become automatically a fixed rate bond. If interest rate falls, a floating rate note can sell the obligation back to the trustee at par plus accrued interest, and it is more liquid than the floating rate note. Similarly, you may have funding coming from some international sources, right? Then you have this venture capital financing. Venture capital financing is with respect to the uh, you know venture capital is it's simply with respect to the startup funding, right? So they have money from the clients, and that money is invested into the startups, right? So these are the equity finance. These are equity finance to new company, which can be viewed as a long-term investment in growth-oriented small and medium firms. Ownership, they don't generally exceed 49%. This is a conditional loan, and depending on the rate of royalty, also it may range from 2% to 15%. It may be a case of participating debentures are issued, right? So these are various sources of funds which you can actually go through, read through it, and in case there are any queries, you can just come up in the next session. Right now, I want to utilize the remaining session with some MCQs. So let's start some MCQ session right now so that you get some idea about what this topic is. Let me share the MCQ with you guys. Okay, so Bulldog bonds are issued in dash by dash, guys. Bulldog bonds are issued in UK by non-UK company, right? Then look at the thing of least accurate. Yeah, it's a equity financing, right? Is it a conditional loan payable in the form of royalty? Yes. Is it a conditional loan repayable at a low rate of interest? No, it's not that case. It's not a conditional loan which is repayable at low rate of interest. So option C is the least accurate over here. Let's look at the next one. Which of the following is true with regards to securitization? Is it a method to convert liquid pool of assets to illiquid securities? No. It is not feasible if there is no active secondary market for debt securities. Yeah, this seems to be true. Let me see the others one. Investors of marketable securities called as a SPV. No, investors are the general public that they buy. Original buyer is aware of investor of securities. No, original buyer doesn't get any idea as to who the SPV is. So basically, securitization is going to be successful only if there is an active market for debt securities. Then, next, which of the following is least accurate with regards to commercial paper? What was the commercial paper? This was the short-term debentures, basically, which are issued by the corporates. Is it a unsecured money market instrument issued in the form of promissory note? Yes, it is. Is it a type of short-term borrowing? Yes, it is. All corporates are allowed to issue commercial papers? No, only the highly rated corporates are allowed. So the least accurate is option C. Cash credit facility is generally sanctioned against which of the following assets? Tangible, intangible, tradable goods, or land. Of course, it is with respect to cash credit. So it's a tradable goods against which the cash credit facility will be sanctioned, and not against any tangible or intangible assets. Okay, next one. Which of the following is least accurate with regards to certificate of deposit? Who issues the certificate of deposit, by the way, guys? It is issued by the bank. So of course it is issued by the bank. Does investor faces illiquidity? No, it doesn't face illiquidity because certificate of deposits are traded in the secondary market. Next, which of the following is best describing the euro bond? Is it a bond traded in Europe? No. It is a bond traded of a European company? No. It is actually a bond which is denominated in currency other than currency of the country in which it is issued. So, for example, Indian rupee bonds issued in Japan, it's a euro bond. US dollar bond issued in India, that's also a euro bond. So whenever you talk of euro bond, it is that bond which is issued in the country, but the currency is of some other country. So that's a euro bond. Okay. Which of the following is not a feature of ADR or American Depository Receipt? Security of non-US companies listed on US stock exchanges. Yes, it is a security of non-US company. Is it a provision of SEC needs to be followed? Yes, because SEC is the Securities Exchange Commission in US. For trading, existing ADR foreign brokers and custodians are involved? No. For existing ADR, you don't need any foreign broker or custodian as such. Right? But yes, companies who have issued ADR, they need to publish their accounts as per the US accounting standards. Okay, so with that, we are through with the MCQ portion also. Okay. Okay, let me see if there are any queries. Ratio analysis is the next chapter, Mohammed. We'll be starting with that chapter in the next session, probably day after tomorrow, right? Securitization, we have discussed it, Mohammed. Okay, very scoring. Yes, it's very scoring, guys. The subject is very scoring. So with that, we are done with today's session, guys. Darshan is asking a doubt. If the right to buy share under warrant exercise, does that mean the bond is cleared? No, bond is not cleared, Darshan. Just the warrant gets exercised. The bond still holds. Bond is still going to be there. Okay. So we'll stop here with that for the day. In the next class, we'll be starting with a really interesting topic of ratio analysis. Okay. So I'll be sharing this document on the portal. You need not worry about that. Right. So let's just stop here. See you in the next class, guys. Good night and take care. Bye-bye.